Welcome to Chillin' 101. We hope this video helps.
You start by getting clean price data for the stock and index. Use the same start/end dates and frequency. Once done, calculate periodic returns in adjacent columns using equals B2/B1-1 or natural log returns equals ln B2/B1. Make sure to remove non-trading dates and align both series so every date has a stock and market return. This prevents mismatched samples and biased beta. Finally, name the return ranges or keep clear contiguous columns for the next calculations. Now compute beta by measuring the relationship between stock and market returns. You can divide covariance by market variance, equals covariance. P, stock range, market range, /var. P, market range. Alternatively, use equals slope, stock range, market range, which runs the same linear regression and returns the slope directly. If you want CAPM-consistent beta, convert both series to excess returns by subtracting the same risk-free rate per period before these formulas. Also check that there are no finish by interpreting and optionally adjusting beta. If you use daily or monthly returns, the beta itself doesn't require scaling, but note annualized volatility and regression diagnostics for reporting. To temper extreme estimates, you can apply the Bloom adjustment, 0. 67 times raw beta plus 0, 33. Make sure residuals look reasonable and R² is sensible. If results look wrong, check alignment, missing or duplicated dates, outliers, and ensure both ranges are the same length. Correcting those usually fixes calculation errors.
Thanks for watching. Consider subscribing if we helped you.